So Daniel Riediker, CEO of Allegra Capital, welcome to World Wealth Creation Conference 2017 here in Singapore. How's it going for you?
Thanks, Perry. Things are doing good. I just come off my little presentation. I think people were interested in hearing how you can manage a credit fund over several cycles. And I showed them a couple of trade examples, and people were interested.
Yeah, fantastic. And certainly funds relating to the to credit. The first thing that springs to mind is the credit crisis of 10 years ago. So how has your organization managed that since then at that time?
Well, it was really a tough time back then because the market was just going crazy. We had positions where we thought they're absolutely money good. There was absolutely no problem with them, but they were trading down to ridiculously low levels. It was sort of a really stress test for the organization as well. People needed to work together. They still needed to be motivated. Everybody around us said, forget this. It was important for us to talk with clients, explain them the situation, and just keep focusing on what we did.
Excellent. And where would you say your key markets are?
We invest primarily in US and European securitizations, and our clients are mainly coming from Europe.
Right, and what sort of returns are you getting then? So you've been around since the early 2000s, right? 2003?
Yeah, sort of our flagship fund, the 2004 fund, has an annualized return of 11.6%. That's throughout the credit crisis. Obviously, in the years of the credit crisis, the returns were highly negative, but then people really made it up quickly. We recovered from the low to the old high watermark within only 17 months.
Well, that's incredible, isn't it? And it just goes to show that a financial crisis, even of that magnitude, with the right type of philosophies, can work their way through it. So what philosophies does your organization adopt?
Perry, there's a couple of things that I think people always should be remembering. First of all, understand what you own and what you buy. Make sure that what you have, that's what we try to do, is really sort of working out. And we were convinced about it. Everybody around was just panicking. We tried to focus, analyze, and then see opportunities as well. Because down markets can always be opportunities, but you need to have the patience and the cash as well. So you need to have loyal customers, and that's always important to talk to your customers and keep them informed, so making sure that they still believe in you. Sometimes that was difficult.
Sure, I can imagine that there must have been some challenging conversations around that time. However, you quite clearly survived quite well, and by, I guess, adopting what I would see as very entrepreneurial and positive practices.
Well, yes, sure. I mean, one of our investment philosophies, we always co-invest with the products that we have. So I have some serious money in these funds as well. And, if we're losing, it's my money that is going up as well. I think it's important to show people we have an alignment of interest and to be transparent and show them what we do and why we do it. And then obviously if they like it, they can stay. We had clients that were putting up additional money in the middle of the crisis, and that took some courage.
Wow. Well, they must have had a lot of faith in you.
Yeah, maybe they thought it was a great market opportunity as well.
Yeah, and achieving annualized returns of over 11% is quite incredible. What would you say is your outlook for the next, let's say, 5 years going forward?
Well, I would say we are in a phase at the moment where markets have started to normalize, spreads are coming down, there's cheap money around all over the place. So I would say there's two things that we would look at. First of all, the environment for defaults, which is really driving the underlying returns on a longer term basis, that environment at the moment is pretty benign. We don't see a lot of problems on the horizon on the corporate default side. But we never know. In 2 years down the road, credits are given looser and looser. So, you have to carefully watch that the companies don't overdo with the leverage, that there's some control clauses in the documentation, and that's always harder and harder to get. Then we have a low interest rate environment. There's a pressure on the spreads. That means that the existing products can go up in value just because we have higher value, higher spread products. But when I look at investing new money, I have to accept that the returns are going to be a bit lower than what we currently have.
Fantastic. And as I suppose a closing sentence, what would you say is your key advice to anyone wanting to invest in the credit markets?
Well, there is a difference between the credit markets and the stock market, right? A loan always has to be repaid at par. So make sure you understand that the subject where you invest into can actually repay it. Look at the default risk. It doesn't need to be a growth story, but you want your money back. And that's the difference to investing into the stock market. It makes it very interesting because there's so many facets to it. But that's the main point. Just be trying to get your money back at the end of the day.
Fantastic. And clearly your organization puts in all the right practices for such a long-term success, even through the worst crisis in history that we know. And congratulations to you. Daniel Riediker, thank you very much for your time.
Thank you, Perry.